I'm not just open to the job, I'm ready to swing the axe on rates. That's the jaw-dropping line economist Marc Sumerlin dropped on live television Thursday, instantly turning a sleepy summer market session into a headline-grabbing spectacle. In one breath, he confirmed he's actively campaigning to become the next chair of the Federal Reserve. And in the next, he called for a 0.5 percentage point slash to the Fed's benchmark rate. If you thought the race for America's top central bank post was already spicy, buckle up, because Sumerlin just threw gasoline on the fire. But here's where it gets controversial. Sumerlin isn't some ivory tower academic who spent decades inside the Fed's marble corridors. He cut his teeth as a senior economist in the George W. Bush White House, a pedigree that thrills supply-siders, yet makes deficit hawks nervous. Translation? His policy instincts lean toward growth first, worry about inflation later. That stance collides head-on with the cautious, data-obsessed culture that has dominated the Powell era. So when he says a 50 basis point cut is a no-brainer, he's not just reading the tea leaves. He's signaling a philosophical revolution. Let's unpack the numbers behind the swagger. A single basis point is simply 1/100th of a percentage point. So 50 basis points equals 0.50%. Sumerlin argues that 3 flashing green lights are screaming for action. 1. The yield curve. Basically, the interest rate spread between short-term and long-term treasuries has flattened so much that banks' profit margins are getting squeezed. Historically, that's a recession warning. 2. The labour market, once red-hot, is showing unmistakable cracks. Jobless claims ticking higher, temporary help payrolls shrinking, and quit rates drifting lower. Translation: workers are getting jittery. 3. Inflation, the Fed's longtime nemesis, has cooled to a comfort zone around 2% on core measures, meaning the central bank finally has wiggle room. Add those ingredients together, Sumerlin says, and you get a recipe where a bold half-point cut wouldn't rattle markets. It would reassure them. And this is the part most people miss. The Fed chair isn't just a technocrat who sets interest rates. That person sets the emotional temperature for the entire global economy. When the chair sounds calm, markets relax. When the chair sounds panicked, traders hit the sell button. Sumerlin's willingness to speak in plain, almost swaggering English, calling a 50 basis point move easy and without disruption, is itself a radical departure from the carefully hedged language we've grown used to. Love it or hate it, that tone shift could redefine how investors interpret every future Fed statement. Of course, not everyone is cheering. San Francisco Fed President Mary Daly has already pushed back publicly, warning that a half-point cut in September could overheat financial conditions and spark asset bubbles. Meanwhile, some Wall Street strategists worry that an aggressive cut might signal the Fed knows something ugly the rest of us don't. After all, if everything is peachy, why fire the monetary bazooka? So where does that leave everyday Americans? Picture this. If the Fed does slash rates by 0.50%, your credit card APR could drop within a billing cycle or two. Auto loan offers might suddenly look sweeter, and mortgage rates, already drifting lower, could dip below 6% for the first time in 2 years. Savers, on the other hand, will groan as high-yield savings accounts shed another chunk of interest. In short, Sumerlin's no-brainer is a redistribution of winners and losers, and the stakes couldn't be higher. Controversial interpretation alert. Could Sumerlin's public audition actually be a strategic leak from the White House itself? An attempt to test market a more dovish Fed before the formal nomination? There's no smoking gun evidence, but the timing, just weeks before the nominating window narrows, is eyebrow-raising. If true, it would mark a brazen politicization of the supposedly apolitical Fed selection process. Now it's your turn. Do you welcome a Fed chair who talks like a hedge fund trader and cups like one too? Or does the thought of 50 basis point moves give you flashbacks to 2008 style panic? Drop your take in the comments. Agree, disagree, or roast us all. The debate is live, and your voice might just shape how the next chair thinks about the economy we all live in.